Welcome to this explainer. Today, we are unpacking the data-driven reasons why the traditional Australian housing market is currently undergoing a massive structural shift. Look, we're witnessing a fundamental change in property economics here, a pivot that honestly hasn't been seen since the post-war boom. We're going to break down exactly why the old ways of building property wealth are rapidly losing their edge and how strategic, high-density developments in major capitals are totally taking their place. If you want to understand where the market is heading next, you're absolutely in the right place. So, we all picture that iconic quarter-acre block, right? You know the one. It's got the Hills Hoist in the back, enough room for a lively game of backyard cricket on Christmas Day, and maybe a nice big wraparound veranda. For decades, that has literally been the gold standard for building wealth in this country. But when we strip away all that nostalgia and look closely at the hard data coming out of our capital cities, we really have to ask a tough question. Is that dream officially dead? And more importantly for us as investors, how do we pivot our strategies so we can actually thrive in this new high-density reality? Okay, let's dive right into our strategic blueprint for today. First, we'll cover the death of the Aussie dream, then the zoning gold rush, how to overcome the affordability ceiling, and finally, the boutique building strategy. Starting things off with Section 1, the death of the Aussie dream and the urban sprawl issue. You see, moving away from that traditional suburban block isn't just some trendy lifestyle choice anymore. It's become a strict economic necessity. Urban sprawl has hit a serious breaking point. I mean, let's be real. Unless you genuinely love listening to podcasts that much, a grueling 3-hour daily commute from the outer fringes is just soul-crushing. When you're spending that much of your life stuck in gridlock traffic or on a train miles from the city, that big backyard quickly loses its appeal. The value of land is still king, absolutely. But the utility of that land, that is completely changing. To combat this massive sprawl, town planners are executing a huge strategic pivot to what they call transit-oriented development. And this isn't just a buzzword, it's a fundamental structural realignment of how our cities actually function. Governments are literally pouring billions of dollars into infrastructure to explicitly support high-density living. We're talking about massive city-shaping projects here, like the new metro lines in Sydney and the big build down in Victoria. They're intentionally clustering future populations around these transport hubs, which, as you can guess, entirely rewrites the rules for where capital growth is going to happen next. Which brings us nicely to Section 2, the zoning gold rush, and how proximity drives value. The absolutely crucial point here is understanding exactly how this infrastructure shift creates unprecedented investment opportunities for us. As a strategic investor today, you aren't looking for the prettiest garden at the end of a quiet cul-de-sac anymore. Actually, scratch that. The strategic value of real estate now relies almost entirely on proximity to these new transport hubs and activity centers. Think about it. When a local government rezones a street of sleepy, older houses to allow for 6-story apartments, the utility of that land transforms overnight. And because the utility changes so drastically, its value absolutely explodes. Let's look at a real-world example to put this into perspective. Right before the Brisbane Olympics announcement, we saw this incredibly clear trend where older, high-density ready blocks completely outperformed traditional housing out on the suburban fringe. Why did that happen? Well, the smart money recognized that the strategic value of those inner-city, well-connected locations had shifted dramatically. Land utility, meaning what you can actually build on the land and how many people you can house in your vital infrastructure, is now the primary driver of explosive value growth. The old strategy of just buying land and waiting is officially being outperformed by buying the right zoning and capitalizing on it. Let's move into Section 3, overcoming the affordability ceiling and the battle of houses versus apartments. Now, you might be sitting there assuming that apartments inherently have lower capital growth than houses. And traditionally, you'd be right. But structural shifts are changing the math entirely. And it really all comes down to one big number: $1 million. As the price of a standard house in our major capitals sails past the $1 million mark, we hit an immense affordability ceiling. This ceiling is mercilessly pricing out a massive chunk of the population. People simply cannot afford the traditional house anymore, which redirects an immense amount of permanent demand straight toward well-located townhouses and high-quality apartments. And when we break down the demographics actually driving this demand, we see a major structural shift. Lifestyle now completely beats land size. Just look at the downsizer boom we're seeing from baby boomers right now. They don't want to maintain a massive yard every weekend. They want lifestyle, convenience, and to be walking distance from cafes and healthcare. Then, add in the young professionals who are totally priced out of the housing market but still want to live near the action. This creates a massive, permanent baseline of demand for high-density living that just didn't exist in the same way 30 years ago. Let's talk about the numbers that actually keep you awake at night. In a high interest rate environment, holding a massive mortgage on a low-yielding suburban house, that can become a total cash flow nightmare. It leaves you deeply negatively geared to the point of severe financial stress every single month. Contrast that with a strategically chosen two-bedroom apartment near a major hospital or a university. The data shows these assets often offer a self-sustaining yield and near-zero vacancy rates. The rental return actually helps you comfortably service the debt while you wait for that long-term capital growth. It's a far more sustainable position, and it mitigates your risks significantly. All right, final piece of the puzzle, Section 4, the boutique building strategy, where execution is everything. Now, a quick warning here. Not all high-density properties are created equal. We've all seen the horror stories of those generic cookie-cutter towers plagued with structural issues, right? To thrive in this space, you have to be highly analytical and completely data-driven. First, you want to target smaller boutique developments. Think fewer neighbors, which usually means lower body corporate drama. Second, you must verify superior build quality. That is absolutely non-negotiable. And third, identify unique architectural features that set the property apart from generic stock. By following this formula, you ensure you're investing in high-quality properties that act as true land substitutes. These are the specific types of assets that securely hold their value even during broader market downturns. So I really want you to remember this crucial distinction. The death of the quarter-acre block isn't something we should be mourning. It's actually a massive opportunity to reposition your portfolio for the next 20 years of Australian property growth. We are witnessing a fundamental market evolution here. It's no longer about securing the sheer quantity of land on the absolute fringes of civilization. It is entirely about securing the quality of location within highly connected, transit-oriented hubs. That is exactly where the wealth of the next generation is going to be built. To wrap up, I want to leave you with a provocative final thought for your own financial strategy. Knowing what we know now about the crippling 3-hour commutes, the multi-billion-dollar infrastructure pivots, and the crushing affordability ceiling of the traditional market, are you still heading for a house on the distant outskirts, or are you pivoting closer to the action with a high-density strategy? Take a hard look at your portfolio, run the numbers for yourself, and decide which side of this structural shift you want to be on. Thank you so much for joining me for this explainer, and as always, keep learning.